Two friends graduate the same year. Same college, same starting salary, same job offer letter, almost word for word. 25 years later, one of them retires early. The other is still working, still stressed about money, still checking his bank account before he buys groceries. Same income, same career, completely different lives. What happened? It wasn't a lottery ticket. It wasn't a stock tip. It wasn't luck. It was one decision made over and over for 25 years. A decision so small that almost nobody notices they're making it wrong. By the end of this video, you'll know exactly what that decision is, and you'll never look at your paycheck the same way again. Here's what almost everyone believes. Earn more, get rich. It sounds obvious. It sounds true. It's also incomplete. Doctors earn 6 figures. So do lawyers, engineers, and plenty of salespeople. And yet study after study shows a huge number of high earners have almost nothing saved. Meanwhile, teachers and mechanics, people earning half as much, quietly retire as millionaires. So income can't be the real answer. If it were, every high earner would be rich, and none of them are broke. But that's where almost everyone stops looking. The real gap isn't in the paycheck. It's in what happens the moment that paycheck lands. Picture the money landing in a bank account. From here, there are only 2 directions it can go. Path 1, it flows out. Rent, dinners, a nicer car, a bigger house, comfortable, deserved, gone. Path 2, a slice of it, sometimes a small slice, gets redirected before it ever gets the chance to disappear. It goes into something that grows quietly in the background. That's it. That's the entire fork in the road. It sounds too simple to explain $1 million difference, but here's where it gets interesting. The size of that slice matters far less than most people think. What actually matters is something almost invisible. Time. Let's test that idea. Imagine 2 investors. Both put money into the exact same investment, a simple fund that tracks the entire U.S. stock market. Investor A starts at age 25. Investor B starts at age 35. Same amount every month. Same fund, same market. Only difference? 10 years. At first, this looks like it shouldn't matter much. 10 years out of a 40-year career? A rounding error, right? Wrong. By retirement, Investor A ends up with roughly double what Investor B has, even though Investor B worked just as hard, saved just as diligently, and eventually contributed almost the same total amount of money. 10 years of head start outgrew decades of extra contributions. Until you see the math laid out year by year, that doesn't feel possible. Let's walk through it slowly, because this is where the story really lands. Someone invests $500 a month, starting at 25. Nothing dramatic. Roughly the cost of a car payment. Year 1, the balance is small, a few $1,000s. It barely feels worth mentioning. This is the part where most people quit. It looks like nothing is happening. Year 10, something shifts. The account has grown past $100,000. Most of that growth isn't from new deposits anymore. It's from money the account already earned, earning more money on its own. Year 20, the balance has crossed $300,000, and it's climbing faster every year, even though the monthly deposit never changed. Year 30, the number on the screen is over $700,000, built from contributions that only add up to about $180,000 out of pocket. The rest? That's not saving. That's growth compounding on top of growth, quietly, in the background, for 3 decades. But that's only half the story. Here's the part almost nobody explains properly. It's not that Investor A was smarter. It's not that they picked better stocks or timed the market perfectly. In fact, most wealthy long-term investors barely touch their accounts at all. The real reason is reinvestment. Every dividend, every bit of growth gets left inside the account instead of pulled out and spent. That money buys more shares. Those new shares generate their own growth, and that growth buys even more shares. It's a snowball rolling downhill, and every extra year it rolls, it picks up more size, not because it's rolling faster, but because it's simply been rolling longer. This is why the 10-year head start beat extra contributions. Time isn't just a factor in this equation. Time is the engine. This isn't a story about geniuses or risk takers. If you're someone who wants simplicity, a broad market fund held for decades does the heavy lifting without needing constant attention. If you're someone who's already behind, started at 35 or 40 or later, the lesson isn't to panic. It's to start now. Because every year you wait is a year the snowball doesn't get to roll. If you're someone earning a great salary but investing little of it, this is the wake-up call. Income opens the door. Investing early is what actually walks you through it. And if you're worried you need thousands of dollars to begin, remember Investor A. $500 a month. No inheritance, no stock picking skill. Just a decision made once, then repeated automatically, month after month, without needing willpower every single time. That's the part most conversations about money leave out. People imagine wealth as one dramatic event, a big raise, a lucky trade, a business that takes off overnight. In reality, for most people who actually reach financial freedom, it looks almost boring from the outside. Same contribution, same fund, same account, left alone for years at a time. The biggest investing mistake was never about picking the wrong fund, the wrong stock, or the wrong strategy. It's spending years waiting for the perfect moment to start, while the one thing that actually builds wealth, time, quietly runs out. The two friends from the beginning of this video didn't have different luck. They had a different starting line. If you'd rather understand the numbers than chase the hype, subscribe. Because every week, we break down exactly how real long-term wealth